Welcome back to the deep dive. Today we are strapping in for a deep examination of one of the world's most consequential companies, Lockheed Martin, or LMT. You handed us a really detailed stack of sources covering their Q3 2025 earnings report, everything from, company filings to analysis from the Wall Street Journal, Reuters, and Yahoo Finance. Our mission is pretty simple, but I think crucial. We are unpacking the financials of this defense giant. We want to understand not just what numbers they hit, but why the market reacted with some genuine skepticism despite what looked like phenomenal results. The core tension we have to navigate here is, well, it's fascinating. LMT beat earnings estimates. They raised their full-year guidance, suggesting massive health and demand. But there is this very nervous undercurrent, kind of a hangover stemming from earlier operational failures. Okay, let's unpack this.
That tension is, it's perfectly encapsulated in the immediate headline numbers. Our quick TLDR for Q3 2025 is that Lockheed reported pretty robust sales of $18.6 billion. Net earnings came in at $1.6 billion, which delivered an impressive EPS of $6.95 per share. On the surface, those numbers are strong, a clear beat on analysts' expectations. But the number that truly signals future confidence is that staggering, absolutely record backlog they reported, approximately $179 billion. That figure alone, you'd think, should guarantee smooth sailing and maybe a soaring stock price.
It should, right. But it didn't. And that's exactly what makes this deep dive so interesting. The market reaction was undeniably mixed. And that mixed reaction didn't come from a lack of demand. It came from an immediate focus on, well, the lingering specter of program execution risk. They are fundamentally being penalized for mistakes they made earlier this year.
Precisely. Though let's not lose sight of the incredible financial health first. Looking at the top line, the $18.6 billion in sales, that's a meaningful increase over the $17.1 billion they generated year over year. That's real organic growth in a crucial sector.
And the cash generation story this quarter was a massive win, wasn't it? Cash from operations wasn't just up. It jumped significantly to $3.7 billion. That is a serious rebound from the $2.4 billion they reported in the prior quarter, which was, frankly, a disappointment. But I have to ask, does that massive cash flow jump look sustainable? Or was that more of a one-time cleanup effort following the Q2 mess? I imagine the street wants to know if they can consistently throw off cash like this.
Yeah, that raises an important question. The sources seem to suggest it's a positive trend reversal, but yes, sustainability is absolutely key. That strong operational cash generation provides critical flexibility for management. They can fund their dividends, continue their share buyback programs, maybe invest more in R&D. When a defense contractor shows this kind of cash velocity, it often signals efficient conversion of prior contract payments. So it's a very positive signal, generally.
And speaking of signals, let's circle back to that $179 billion record backlog. It's difficult to overstate the significance of that number.
Well, what's fascinating here is how the street views that backlog. It is the ultimate measure of revenue visibility. It guarantees Lockheed a multi-year, highly visible revenue stream, really reinforcing their status as the preeminent defense contractor. It signals massive ongoing contract wins, driven by geopolitical tensions and global defense spending. You simply cannot find better visibility in almost any other sector globally. It's quite unique.
And that stability, presumably, gave management the courage to raise their full-year guidance. That's always a vote of confidence, isn't it? They nudged the sales guidance up to a new range of $74.25 billion to $74.75 billion. And the new EPS outlook looks great, moving up to $22.15 to $22.35 per share.
Exactly. And we saw broad strength across the portfolio supporting this optimism. Aeronautics, which contains the F-35 program, showed impressive growth, up a significant 12% year over year. Missiles and fire control and space also contributed meaningfully to the overall beat. So the demand picture, it looks like pure gold.
Okay, so that is the gold medal story. Record backlog, huge cash flow rebound, raised guidance. The numbers really do paint a beautiful picture of a company benefiting from intense global demand. But to understand why the market reacted nervously, we have to transition to the bad and maybe the ugly parts of the report, the risks that really worry investors. This is where it gets really interesting.
Yeah, the problem isn't really Q3 itself. The problem is the hangover from Q2 2025. Despite the solid performance this quarter, there is this serious overhang from that massive pre-tax charge they took, a staggering $1.6 billion that hit their books previously.
And the sources we looked at confirm where those problems originated. The charge was tied directly to issues on a highly classified aeronautics program and also production snags with a major Sikorsky helicopter program. Investors are incredibly sensitive, understandably, to the risk of repeat surprises like that.
And this raises an important question, right? Why do these issues seem to happen repeatedly in the defense sector, especially for these classified programs? The insight the analysts are focused on is this. Lockheed is often asked to push technical boundaries, rely on proprietary next-generation tech. When you're doing that, the cost estimation is inherently difficult. It makes margin predictability extremely challenging compared to, say, commercial builds. They're kind of flying blind on some of the most complex parts of their business, and that inevitably leads to margin compression and sometimes these massive write-downs.
Right, so it means the company is almost structurally set up for these kinds of massive shocks. And that leads directly to the two major risk types cited in the analysis we reviewed. These explain this persistent nervousness. The first is execution and margin pressure.
Exactly. While the consolidated results look good on the surface, specific pockets, particularly those hyper-complex classified programs and certain international helicopter builds, they have a history of showing cost overruns. The market is just not yet convinced that the risk of those overruns happening again has fully evaporated. It's not just a memory, it's an acknowledged operational risk that, impacts future contracts too.
And the second major type of risk is external, what we often call the macro risks. We're talking about supply chain disruptions, general inflation, the usual suspects these days.
This is where we probably need to slow down a bit and define the mechanism,
Yeah.
because it's critical. Lockheed has huge portfolios of what are called fixed-price contracts. For those contracts, they basically agreed to a specific price with the government maybe 3, 4, or even 5 years ago. They can't just go back to the customer now and ask for a 15% increase because, steel prices or specialized labor costs spiked last year. They had to absorb the difference.
So those fixed price deals signed years ago become a kind of ticking inflation time bomb. Their margin suddenly becomes dependent on global macroeconomic stability they have absolutely no control over. If material costs continue to climb due to inflation or geopolitical issues, they simply eat the cost, and their margins, even if strong now, could erode quickly.
Absolutely. And then there's what you call the truly ugly risk,
Yeah.
the risk of concentration. Think of LMT like a high-stakes casino where almost all the money is riding on maybe 3 very large, very complex bets. The F-35 fighter program, those classified programs, and the major helicopter builds.
So if just one of those three massive programs has a bad quarter, say, a technical fault pops up, or a key supplier has a major issue, your entire portfolio, the entire company's financials, takes an outsized massive hit. That's the concentration risk the street really hates. It explains why the stock was so volatile despite beating Q3 earnings. Markets fundamentally punish that kind of program uncertainty, even when overall demand is just overwhelming. Okay, moving on. Let's look at how the street reacted to this mixed picture of record demand versus this persistent execution uncertainty. Summarizing the analyst sentiment, it seems like it was generally constructive. They applauded the raised guidance, the sheer strength of that backlog. That led to several upgrades or, reiterations of buy or overweight views.
But we definitely need to balance that positive sentiment with some serious caution. The analysis we reviewed showed analysts warning that the prior quarter charges prove execution risk is extremely real, not just theoretical. The expectation moving forward is high. LMT absolutely must deliver clean quarter-to-quarter margins and avoid any further program surprises. The market is essentially giving them maybe one chance to prove they fixed the internal management issues that led to the Q2 problems.
So what does this all mean for someone tracking this company? What's the practical investor thesis right now, kind of blending the good news and the bad news?
Well, the primary thesis is still powerful. Lockheed is undeniably benefiting from strong global defense demand. That creates a multi-year, multi-billion-dollar revenue runway based purely on that $179 billion backlog, plus the robust cash generation we saw in Q3. That's a powerful positive signal for capital returns, dividends, buybacks.
But as always in defense, there's the big but. Always a but.
The big but is entirely focused on operational stability. That's the key phrase. Upside requires the company to successfully scale margins on new contracts and, most importantly, completely avoid repeat large program charges. The sources are crystal clear on this. If additional program issues surface, the downside risk will likely be swift and painful. Operational execution, not market demand, is now the critical choke point for the stock performance.
Right. Now, let's shift focus to actionable knowledge for you, the listener. What specific data points should we be monitoring moving forward? How do we track LMT's success, or lack thereof, in achieving that operational stability?
Okay, first on the watch list, absolutely must be quarterly segment margins. You need to pay laser attention to the detailed margins reported in the Aeronautics division, specifically looking for margin stabilization in those classified programs. And critically, also the Sikorsky helicopter division, which was, remember, another source of the earlier massive charges. Any weakness there will spook investors.
Second, look for any further disclosures on the previously charged classified program. The market really needs to know if that specific issue has been definitively resolved. Has there been a restructuring? Have they renegotiated terms with the customer? We need some kind of evidence that the company has effectively closed that particular wound. Silence isn't necessarily golden here.
Third, you need to monitor the backlog composition. That $179 billion figure is fantastic, sure, but we need to know how much of that is actually near-term funded and is expected to convert to revenue within, say, the next 12 months.
And we care about near-term funded because while $179 billion is huge, if only, say, 10% of that is actually funded and ready to turn into revenue next year, the cash velocity is slower than the headline number suggests. Funded backlog shows us the immediate revenue health and the short-term confidence of government budgets actually flowing.
Fourth, keep tracking the sustainability of management's capital returns. Watch the free cash flow and the buyback cadence. Q3's cash flow was strong, yes, but we need to see if they can maintain that kind of robustness quarter after quarter. Also, keep an eye on new contract awards, particularly international sales, as they indicate growth beyond just the baseline U.S. budgets. That shows broader market penetration. So to summarize this entire deep dive concisely, Lockheed beat earnings and raised guidance with a record backlog. That signals immense defense demand and strong cash flow recovery this quarter. However, the operational execution, their ability to actually manage those incredibly complex contracts profitably, remains the central overshadowing vulnerability. And that ensures investors remain deeply wary despite the recent financial successes.
That brings us right to the fundamental conflict facing LMT going forward, doesn't it? The sources really show that LMT is a company defined by almost unbelievable complexity, operating right at the bleeding edge of technology, often under these rigid fixed price structures we discussed. So how does a company with guaranteed multi-decade revenue streams from a record $179 billion backlog manage the constant threat of internal operational risks? Things like unexpected technical flaws or sudden supply chain issues hitting those complex fixed-price programs. How do they ensure that these isolated internal management issues don't repeatedly overshadow the massive, frankly unstoppable global demand for their products? That operational stability, that execution piece, is the absolute key metric. It dictates whether this defense giant truly capitalizes on its incredible market position or repeatedly trips over its own internal complexity. That's the story to watch.